Welcome to Trading with MACD Part 2, presented by DailyFX Education. In Part 1, we introduced in simple terms the MACD indicator. We provided a number of examples where traders use a crossover of the MACD line over or under the signal line to represent a buy entry or a sell entry. To quickly recap, you can see here that the MACD line has crossed over the signal line. This situation in an upward trending market could be taken as an opportunity to go long or to buy. We can see here that the MACD line has crossed below the signal line. This situation in a downward trending market could be taken as an opportunity to go short or to sell. These examples illustrate a very common use of the MACD indicator. After discussing crossovers, we moved on to discuss MACD divergence. There are two types of divergence, positive and negative. Positive divergence occurs when the MACD prints a new high, while the pair's price prints a new low. This situation, like you see here in this example, is considered to be bullish and is often taken to mean a slowdown in trend or a full reversal to the upside could occur in the near future. Negative divergence, on the other hand, is where the MACD prints a new low while the pair's price prints a new high. You can see negative divergence present here in this example. Negative divergence is considered to be bearish, and traders will often consider this to reflect a slowdown of trend or possibly a sign that a full reversal to the downside is approaching. MACD crossovers and divergence are very popular and serve as a great trading tool. However, the MACD indicator has much more to offer to traders, and I'd like to share some of these benefits with you in our Part 2 video. We'll begin with a look into how and why the MACD indicator was created. An understanding of this will help you use MACD at the right times. As a side note, I like to think of MACD as a fine-tuned moving average crossover tool, and you'll see why in a moment. After shedding light on the benefits that MACD offers over other indicators, we'll move on to talk about how you can use MACD to identify trading opportunities, in addition to the MACD crossover and MACD divergence. We'll follow this up with a discussion on calibrating the indicator's input parameters based on the pair and market conditions that you're trading to obtain the best market information possible. And finally, we'll discuss exit strategies, where we'll use MACD to manage live trades. Now we've got a lot to talk about, so let's get started with how and why the MACD indicator was created. In technical analysis, one of the most frequently used concepts is the moving average crossover. With this concept, traders utilize two moving averages, where each moving average is calculated with a different number of periods. Say a 20-period moving average for the first indicator and a 200-period moving average for the second indicator. There will be times when the two moving averages will cross over each other. Traders will note these crossovers as an indication that the trend is changing and possibly as signals to enter into trades. We're currently looking at a daily chart of the dollar-yen. You can see that there are two exponential moving averages plotted on it. The blue line is a 20-day exponential moving average, and the red line is a 200-day exponential moving average. Traders who use moving average crossovers would most likely sell at the crossover represented by point A, and close their trade at the crossover represented by point C. The entries and exits are easy to recognize, which is one of the reasons for using this approach. But even with its popularity, there is certainly a weakness to this approach. By closely looking at this chart, you might have already noticed what the weakness was. Due to the strong downtrend that ensued after our entry at point A, the crossover that got us into the trade wasn't all that bad. But what about our exit at point C? Due to the fast retracement that you can see here, we gave up over 1,000 pips waiting to exit at the crossover at point C. Ideally, we would have preferred to have exited near point B and hung on to at least some of those 1,000 pips that we gave up. This example illustrates one of the main problems with technical indicators, specifically with moving averages. It's a lagging indicator, which means it shows what has already happened in the market and is slow to react to current market conditions. This condition was recognized by a gentleman by the name of Gerald Appel. Appel too wanted a signal that would help him exit at point B rather than point C. What Appel noticed was that from point B to point C, the two moving average lines started to move closer together. And with this he wondered, what if I exited as these lines moved closer together instead of waiting for them to completely cross? Perhaps this could improve my trading results if I could find a way to measure the distance between the two moving averages and not only focus on their crossover. And with this, Appel began working to create the MACD, or the Moving Average Convergence Divergence Indicator. Now that you know why the MACD was created, let's readdress the components of the MACD indicator to get a further understanding of what Appel was trying to accomplish. First, we have the MACD line. This line shows us the distance between two moving averages, which is exactly what Appel was looking for. With most charting packages, the default settings for the MACD indicator are 12, 26, and 9. The first two numbers, 12 and 26, represent two exponential moving averages. Therefore, with the default settings, the MACD line would show us the difference between a 12-period exponential moving average and a 26-period exponential moving average at any given time. As the two moving averages move further apart, the red MACD line will rise. When the moving averages move closer together, the red MACD line will fall. With this, Appel gave us a great tool to measure the distance between two moving averages. Or maybe a different way to put it is Appel developed a tool to measure price momentum. Now the MACD line alone is truly beneficial to a trader, but there is another component of the indicator called the signal line, which for the MACD crossover strategy is the icing on the cake. The signal line is actually a moving average of the MACD line. When using the default settings of 12, 26, and 9, we're specifying that the signal line be a 9-period moving average of the MACD line. The line was added by Appel to help spot entries and exits. It's not that he wasn't a fan of the moving average crossover, it's that he wanted to further optimize it to try and improve his trading results. As I mentioned at the beginning of this video, this is why I consider the MACD to be a fine-tuned moving average crossover tool. We're still able to trade moving average crossovers, but with a MACD crossover, Appel gave us an opportunity to act more quickly on changing momentum, which is one of the main benefits of the MACD indicator. At this point, it should be clear why the MACD was created and what advantage it can provide traders. Now that you have a better understanding of how the MACD indicator is constructed, let's build on that knowledge and discuss some additional ways to trade with it. First, let's build upon our basic MACD crossover strategy that we covered in the first video. MACD crossovers can indicate to a trader that the momentum and short-term trend are likely changing. With this information, we look to enter positions as the MACD line crosses above or below the signal line. Of course, taking signals that were in the direction of the trend, not against it. But in the first video, we presented the crossover from a more conservative approach. You might not have noticed it, but in all of the examples, when the MACD line crossed above the signal line, the crossover was above the center line or zero line. And when the MACD line crossed below the signal line, the crossover happened below the center line. Again, this is not a bad approach, but it's certainly a more conservative approach and generally works very well on longer time frames. Another way we can use the crossover, though, is by fine-tuning it a bit more and broadening its use. This is done with the use of multiple time frame analysis. The basic concept does not change, except that in this approach, the crossover can occur above or below the center line. Additionally, in the approach, divergence often appears, which can increase our confidence when entering positions. The basic building blocks of this approach are to locate the trend on a daily chart, and then to move to a shorter time frame chart to locate your crossovers, which we'll use for our entries and exits. Here we're looking at a daily chart of the euro-dollar. A trader can identify the direction of the trend to be up by simply standing back and noting the general direction of prices. Seeing a series of higher highs and higher lows is one of the ways we can confirm that the trend is heading up. But it's also possible to determine the direction of the daily trend by simply noting the placement of the MACD line relative to the center line. When the red MACD line is above the center line, like it is in just about this entire chart, you can consider the daily trend to be up. When the red MACD line is above the center line but heading down, like you can see here and a few other places along this chart, you can still consider the trend to be up because the MACD line is above the center line, but likely the market is temporarily correcting downward. These corrections are also called pullbacks. This can also be noted when the red MACD line is above the center line while the green bars of the histogram are below the center line. In any case, we can see through multiple methods that this daily chart is currently trending up. Since the trend is up, we now want to look for buying opportunities in the direction of the trend. To fine-tune our entry, we'll scale down to a smaller time frame. and in this case we'll look at a 4-hour chart. When looking at the 4-hour chart, we want to note when the red MACD line crosses up above the blue signal line. When this happens, we can enter a buy position,